I'm Joanna Simpson here at RiskMinds International in London. Joining me now is Stuart Smith, co-head of business development at Acadia. Thank you very much for joining me.
Thank you.
And the US has just published its Basel III Endgame regulations. How is this going to impact the US?
So I think firstly, the rest of the world sort of pleased to see the US finally sort of catching up effectively with a lot of the Basel regulations that have been around the rest of the world for a long time. For the US, they've taken a really gold-plated approach to the regulations, and they've looked to push forward further than maybe other places, and that's going to push up capital in many places, which has been a big conversation point after that. In particular, around counterparty credit risk, they've looked to remove the option for IMM, which is seen as a surprising move, and I think caught a lot of people by surprise in the fact it's not there. And it's going to change a little bit how the US approaches those things, although it's in line with how other people use output floors as well.
So what has been the reaction so far?
So it's been quite vociferous around the pressures on capital and the increase in bank costs and how that could impact the US economy. It's surprising to see the amount of pushback the regulations have received, given they are effectively global regulation that's been adopted elsewhere. And it's important to see that these still need to pass through the US government. And it's not obvious at this point whether they will come through as they've been stated, or whether they'll have to be a compromise position, or in fact could get rejected completely.
And there have been some major defaults over the last 3 years. What lessons can be learned from those about how we measure risk in future?
It's a really interesting area, and some of the examples of those defaults, if you go all the way back maybe to Acadia, is really causing us to question how it is we even measure counterparty credit risk. A lot of work has gone into seeing how the advent of uncleared margin could have averted a problem like Acadia, and the reality is that it wouldn't have done. Really, people are having to relearn a little bit what counterparty credit risk means in the presence of an excess of collateral. And how those margin-driven defaults can really change what's happening. As we'll go away from Acadia to the knock-ons at Credit Suisse, or also to SVB. I think many, many lessons have been learned around how simply the management and calculation of risk is insufficient, but also the overarching management of the organization, the risk culture, is important as well. And then how that's played through or hasn't played through in those cases, and allowed some of those firms to go into default.
And as firms try to manage the additional costs of compliance with new regulations and increase capital, how are optimizers helping to manage those costs?
With optimization, I think it's become a key part of what banks do. I think it was really launched through uncleared margin, where that provision of clean data through ISDA-GRIF files was a revolution. It allowed a whole bunch of entities to come into the market offering these services, able to get data in a standardized format across the board for all the banks, and run optimization across the board. And that's been key, and it's changed a little bit the way the margin is managed and costed into business. And really radically changed how firms look at those costs and how they look to manage with an ongoing fashion. And those optimizers have been able to bring down cost of margin substantially, 30-40% across some of the largest banks, and are looking at how they can push that out into smaller banks and into the buy side as well.
And how important is clean, accurate data for optimization?
I think it's key, and as optimizers have launched an ISDA SIM where they have this beautiful clean data available to them, they've then realized it's important to also look at the balance of that against capital metrics like SACA. And what they find when they go outside of ISDA SIM is that those other metrics don't have those same types of clean data available. In particular for SACA, you can see very big discrepancies between how banks, who theoretically should have a similar representation on both sides, have very different views of what a SACA is. And that can really impact the ability to optimize, in fact bringing it down all the way to zero in some cases, or severely impairing it. It's really interesting to see how we can take some of the lessons from uncleared margin into those other areas and see if we can also improve the data quality in those, and as banks get for the improved optimization knock-on benefits from that.
And what do you see as the major trends within the counterparty credit risk space for 2024?
So what we see is really interesting is how the spaces of XVA and counterparty credit risk are coming together. The way those two areas grew up very much was divided between the middle office and the front office, with two parallel infrastructures developing. Whereas in reality, going forward, people are looking to bring those back together and generate the cost savings from those. So really interesting area around how the calibration of those models may well change, and look to the risk neutral approach taken by many of the XVA models and seeing if that can satisfy the L2, the middle office counterparty credit risk requirements as well. and seeing if those models backtest going forward is going to be a fascinating area, certainly for us.
Stuart Smith from Acadia, thank you very much for your time.
Thank you.